everyone, it's Dave Barnett from investlocalbook.com. This week I've got a small business finance management question from Phil, who asks, what about working capital? Where can I get it and what is the cost? Before we get into that though, let's have a discussion about what we mean by working capital. Working capital is the money that you have to invest in a business to get your products or services from the point where you start working on your raw materials or start creating your service up until the point that your customer pays you. Okay. Now, assuming that we have a profitable business, that money then is going to revolve within the business and we'll be able to take our profits out. And as the business grows, the operating capital may have to grow. And if we don't grow too quickly and we're profitable, we should be able to grow the operating capital as we grow our profits and grow our business. But if we are starting up a business or if we're growing too rapidly, we may not be able to have enough profit to grow the working capital as quickly as it needs to grow. So for example, if I buy raw goods and I have to pay for the goods when I get them, and then it takes 30 days to transform them into my finished product. So let's say it's $10,000 worth of stuff. It takes me a month in order to turn it into my finished product. And let's say I sell it immediately to my customer, but he takes 30 days to pay me. Then I've got $10,000 tied up for 2 months before I get paid and I have my costs are recovered as well as my profit is received. So if I'm selling $10,000 worth of products every month, how much operating capital do I need? Well, it's not $10,000 because when my goods that I bought at the beginning of the first month are completed, I then sell them. I start waiting to get paid, but on that day I have to buy another $10,000 worth of product to start working on for the next month's delivery. So I actually need $20,000 worth of working capital for a company that has sales of $10,000 a month if we have to spend the money and collect 60 days later. So let's talk about where we get operating capital. And the place we're going to actually start with is the balance sheet. Let's take a look. All right, so here on the whiteboard, I've actually created a sample balance sheet, and let's review it. So assets are on one side of the balance sheet, and your assets always have to equal your liabilities and your equity. So if you look at a business balance sheet, you're going to see that it's divided this way. And sometimes it's presented with the assets on top of the liabilities and equity. But even so, they still balance. One side equals the other. So on your assets, you have cash in the bank, receivables, inventory, and work in progress. On the other side, liabilities, you've got your payables. This is money you owe to your suppliers, lines of credit, credit cards. I didn't put loans on here because typically bank loans are for capital goods, things that you use over a longer period of time. Usually when we're talking about operating capital, a bank will create a line of credit and they'll secure that line of credit against certain assets, typically inventory and receivables. And the idea being that that line of credit moves up and down over time, whereas a loan is usually against a fixed asset that we know has a 10-year life, and maybe we're going to pay for it over 7 years, and that gets paid for in an even fashion over the life of its usefulness. Down here in the equity section, we have retained profits, which is simply the profits of the company that we don't take out. We leave that money in the company to help the company grow. And then I put owner's contributions, and you could see that on a balance sheet in different ways. It might be shareholder equity or shareholder contribution, some sort of jargon like that. It all means the same thing. It's money that the owner of the company has taken out of his own pocket and put into the business to help it function. So when you start off a business, of course, you don't have any retained profits, but you probably have some money of your own that you put in to help you get going. So that would be an owner's contribution. And then maybe you go to the bank and you say, look, I need some inventory, and let's say the bank agrees that the inventory is of a certain nature that they don't mind making a loan, what we call fungible inventory that's non-perishable. So 2x4s, for example, are fungible. It doesn't matter who made them or how old they are. They're still a 2x4 piece of wood. And non-perishable means that it doesn't have an expiry date that's upcoming. So for example, it's much more difficult to get the banker to give you an inventory financing for lettuce, because if you don't sell it in time, it goes rotten, and then the value of your inventory disappears. It's difficult to get an inventory loan against, for example, ladies' dresses, because at the end of the season, they may no longer be fashionable or suitable for the time of year, and all of a sudden your inventory again has no value. So if your inventory meets certain criteria, you can get a line of credit. Now the question was, what are the different costs for the different lines of credit, or for the different sources of operating capital? So payables is money that we owe our suppliers, and payables typically we get 30 days before we have to pay our supplier in certain industries. Some industries go longer, 45, 60, even 90 days or longer, and you can negotiate sometimes those terms. So I had a client once who was a guy in the road building and underground services industry, where he used to install things like sewer pipe. He had a deal with a supplier of concrete sewer pipe where he paid that guy in 120 days. So it's whatever you negotiate. So really, you can finance operating capital from payables for 0%, because it's literally your suppliers investing money in your business. Okay? And depending on your relationship with them, they have the power to be very generous with you, or maybe if you're someone who doesn't pay your bills on time and they get frustrated with you, then of course they demand cash on delivery, COD, which means you don't have access to this type of working capital at all. Lines of credit, typically prime plus kind of financing. So depending on the credit worthiness of the business and of you as an owner, if we're talking about a small business, this could be anywhere, from maybe 5 to 10%, depending on which country you are and how much you're borrowing and all that kind of thing. Credit cards, if used wisely, are 0%. Why do I say they're 0%? Simple. You use a credit card to buy some goods. When the statement arrives, you have a certain number of days to pay it in full on time. And if you are set up in proper order and you pay that credit card in full every month on time, you never pay any interest charges. If you are not well organized and disciplined, then, 9 to 29% is the cost. If you want to learn more about how to properly use credit cards in a small business, then you should read my book, Credit Card Advantage. It's available from Amazon and from the investlocalbook.com website. So, and then cost of equity, basically, what sort of return do you demand out of your business? And if your business is struggling to grow and you're just starting off, you're probably not demanding much of a return out of your business. But in bigger companies, they often look at the return on equity as one of their key performance indicators. And in big publicly traded companies, shareholders often demand a certain dividend based on their investment in the shares. So they can actually calculate a cost of this source of capital as well. Often, 10, 20, 40%, depending on the industry. However, a lot of the time, our challenge with operating capital is not actually a challenge with operating capital, it's a challenge with cash management. So in the example I started off with, you buy $10,000 worth of inventory. Your cash goes down by $10,000, your inventory goes up by $10,000. You then spend 30 days converting that into your finished product. So then the inventory goes down by $10,000 and your work in progress goes up by $10,000. These are all still assets. We're just changing where on the balance sheet or what form these assets take. We then ship the products to our customer. We send them a bill. It changes from work in progress back to inventory briefly, finished goods, and then changes into a receivable. Okay? So again, all just moving its form on the asset side. So a lot of the times in a small business, you might have a whole bunch of receivables, for example, and inventory, and what you need is cash. And that's the crisis. On paper, you might have enough operating capital, but it's not in the right form. So there are other ways that we can convert the form of inventory. So for example, if you have a lot of receivables and you need cash, you can use a process called factoring. What factoring is you convert a receivable by selling the receivable. So your customer no longer owes you the money, they now owe it to the factoring company. And the factoring company pays you in advance on that receivable. So a $1,000 receivable, if you sell it to the factor, they might give you $800 today. So now we've moved money from the receivable line into the cash line. And when the customer ultimately pays the factor, they may withhold $30, a 3% fee, for example, and then send the other $170 to you at that time. So it's kind of like what many businesses that accept credit cards experience, where they accept credit card as a form of payment and it ends up costing them a discount fee somewhere between 2 and 4%, depending on the type of credit card. Again, read Credit Card Advantage. The whole book is literally about that stuff. So this type of cost could cost you 3% as a fee. So if you're relying on it month in and month out every month, you could look at it from an annualized point of view and say that, it costs over 30%. But with factoring, I've known a lot of companies that do factoring at some parts of the year, or they factor certain customers but not others, etc., just to give themselves the amount of liquidity or available cash at hand that they need to keep things functioning in a sound fashion. So basically, I hope that answers your question. These over here are your uses of operating capital. So we use our capital literally to finance receivables, have the inventory, and finance the work in progress. And over here, the liabilities, these are actually our sources of operating capital, where we borrow money to help our business go. And then, of course, the equity down here is also a source of capital. I hope that answered your question. If there are any other questions about this kind of stuff, please don't hesitate to send me an email, dbarnett@alpatlantic.com. Don't forget to visit my blog site, sign up for my email list. Email subscribers always get my latest videos first. Thanks, and we'll talk to you next time.
Hey, you made it to the end of the video. That's great. Don't forget, visit www.investlocalbook.com. Sign up for my email list. It's right down here under the welcome video. Thanks, and we'll see you next time.